And good morning. This is Dr. Shankar Babu. I have 33 years of teaching experience in the Department of Commerce. Out of that, I worked 5 years in abroad, 2 years in South Africa, and the remaining 3 years I worked in Saudi Electronic University in Saudi Arabia. Let's discuss today pertaining to the funds flow statement. What is meant by funds flow statement? Why it is necessary to prepare the funds flow statement? And what role and a significant role played by the funds flow statement. Everyone knows that the business prepares at the end of every year or once in the financial year. They have to disclose their results, whether they're earning the profit or loss. In some jurisdiction, it is mandatory. For example, if you take a joint stock company or a partnership business, whenever the people wants to know whether your company getting the profit or loss, you should disclose your results every year by preparing a comprehensive income statement and statement of financial position. These two are very important documents. Why? Because if the investors are there, if they want to take the decision whether to continue their investment in your organization or whether they want to divert their investment to the other organization, how is it possible to the investor when you do not disclose your profits and losses? In the same way, some of the stakeholders, they also need the results of your company. Otherwise, they cannot make any decision, like stakeholders like creditors, bankers, or the financial institutions, or investors, prospective investors, government, those who have a connection with your business. These people are very curious to know your profit. So that's why you'll prepare the two important documents. One is the profit and loss account. In CMA and ACCA, you will call it as in the international accounting standards. As per one, it guides you how to prepare the comparative income statement, comprehensive income statement, and statement of financial position. Not only this, and other documents also important financial statements also will prepare, like cash flow statement, and also maybe another statement like changes in equity share capital. So when you are preparing the financial statements, you can know whether your company is getting a lucrative or getting a detriment. As per time period concept, this is very important to prepare the comprehensive income statement once in a year. And by preparing the statement of financial position, you can know your financial position of your company, whether you are a solvent or you are on the verge of the insolvent. So these two important documents are very important to cognize whether your company's financial position is strong or your company financial position has been lessened to the table. Then you'll make the decision. But these two important statements decides your profit, determines your financial position, but these two statements are not sufficient to know the movements of the funds, to know the changes in working capital. Therefore, another statement has come into the force that is called funds flow statement. If you want to know the movements of the funds in your business, or if you want to know the sources and application of the funds, if you want to know the where got and where gone statement, it is not possible basing upon a comprehensive income statement and a statement of financial affairs. Definitely, you should go for another statement, that is the funds flow statement. This statement is also called as application and sources, or inflow and outflow statement, where got and where gone statement, and sources and applications. Let's know what are the steps has been involved in preparing this funds flow statement. Number one, you will be provided 2 consecutive years financial data. After taking into consideration these 2 years consecutive financial data, you should prepare the funds flow statement. The number one is changes in working capital. What is meant by working capital? First of all, let's know the working capital. Working capital is a capital which is needed in the hands of every businessman in order to meet the day-to-day expenditures like salaries, rent, advertisement, and it is nothing but the distinction between current assets and current liabilities. Let me define what is current asset. An asset which can be converted into liquidity or which can be changed into cash easily, that is called a current asset. Example, debtors, receivables, bills receivable, inventory, prepaid expenses, short-term loans given, advances given, accrued incomes. So these are all called as a current asset. What is current liability? A liability which is to be paid in a short span, below 12 months or below 1 year, is known as current liabilities. Creditors, bills payables, outstanding expenses, maybe anything. Either it is a salaries payable or rents payable, whatever the expenditure is outstanding, that comes under current liability. Provision for taxation, proposed dividends. So these are all considered as current liabilities. Working capital is nothing but the difference between current assets and current liabilities. Let me say that first of all, statement showing changes in working capital. You are given 2 periods current assets, 2 periods current liabilities, pertaining to 99 and 2000 year. Your 99 current assets is, for example, 1,50,000. I'm saying the total, the summation of all current assets. And the summation of all current assets in 2000 is 1,50,000. In order to get the working capital, you should deduct the current liabilities of the concerned years. Your 99 current liability is 80,000. And your 2000 current liability is 1 lakh. Once again, current assets is 1 lakh. Your current liability is 80,000 in the last year, previous year. The difference is 20,000 is the working capital. Current year, current assets is 1,50,000. Current liability is 1 lakh. So your working capital is 50,000. Last year working capital is 20,000. Current year working capital is 50,000. Now, we have to decide whether this net working capital is increased or decreased. Last year 20,000 and current year 50,000. Your working capital is increased by 30,000 rupees. What is happening? You are spending more. You are using more amount than the last year for the working capital.